You always want to choose the property with the best return on investment, right? But return on investment does not always mean it is the best deal. If you want to keep and grow your wealth, you have to balance your real estate portfolio with risk and return on investment. In this video, I'm gonna teach you 4 investment strategies that will help you to balance your portfolio and keep and grow your wealth. Let's dive into it. So here we have the 4 real estate investment strategies to keep your wealth and grow your wealth. So when we are talking about these 4 strategies, we have to grab the risk and the return on investment. So we can see here that the core investment is a strategy with the less return on investment, but also with the less risk. So for the core strategy, we have new properties. Almost all the times we have new to 5 years old properties, and we have credit tenants. If we are talking about, for example, retail, or we are talking about industrial, we have credit tenants. These are companies that are listed in the New York Stock Exchange or in other stock exchanges, and they have a good credit. For these properties, we also have stabilized rents. That means we already rented out, and we have at least 1 year the property has been rented out, so we can get the numbers on the expenses and also on the income we have on that property. We have almost no uncertainty here, so we can value the property because we have the cash flows. All right, so this is the core property. On the core plus property, we have a little bit more of risk, but we also have a little bit more on return on investment. Okay, let me mention something I forgot. For the core property, if we are, for example, talking about multifamily, we may be talking about an internal rate of return of about maybe 10% or maybe 8%. And on the core plus, we add maybe 2 points on that. It's a little bit riskier, but almost is the same as the core. But we have maybe under market rents. We have a property that is mostly new or 5 years old, maybe 10 years old, a little bit older, but we still have good tenants. And we have maybe the last owner didn't increase the rate over the 5 years, and we have to increase the rents. And if we increase the rents, we may add some value to the property, because you know how it works in commercial real estate. If you increase the rents, you increase the value of the property. So also here we may have some minor updates, like some fresh paint here and there, or maybe broken window or something, but not a big deal. The most where we can add value here, it's by increasing the rents, okay? And we have a little bit more of return on investment, maybe 2 points over the core strategy. Okay, we have also the value add. This is what you know as the flipping strategy maybe, or the renovation strategy, but bring it to the commercial real estate world. We have a property that it's 5 years or older maybe, and we have most of the times, if we are talking in commercial properties, maybe we have some credit tenants, but most likely we have non-credit tenants. So these still are companies that are maybe listed on the New York Stock Exchange, but they are less credit than the core tenants. And this property, we have major updates. We may have an older building. We have to replace some cabinets, some paint, some structures, some walls. Maybe we have to renovate the floor plan. So we have major updates, like in the flipping business. So once we make those major updates, we increase the rents, or if these tenants cannot pay the increase on the rent, we find new tenants. And in that way, we increase more the value of that property, because maybe we go for, let's say in industrial, maybe we go from $7 per square feet to maybe $12 per square feet. So we almost double the value. In opportunistic strategy, this is the most riskier. You have the most risk here, but you have the most return on investment. We are talking return on investment, maybe in value add, we were talking about maybe 16 internal rate of return. In opportunistic, we are talking about maybe 20% and over. Okay, but this is the riskiest strategy. So opportunistic is mostly ground up development. So you have to purchase the dirt, the land, and then build from the ground up. Okay, so that is not easy, because you have to find a land it's already zoned for what you want to build. So if you're looking to build a multifamily building, you have to find a land that it's already zoned for multifamily. If it's not zoned in multifamily, let's say you acquire an old industrial building, an old warehouse, and it's zoned industrial. So you have to make the rezoning here. You have to go with the city, you have to deal with the neighbors, and that's a long process. It takes at least it takes 2 years to build something in this. But with that risk, it comes better returns. You have other strategy. Well, in this same opportunistic, you can do a redevelopment. In redevelopment, for example, this old industrial building I told you, instead of tearing it down, instead of demolishing the structure, what you do is you do a rezoning, and you convert that industrial, that old, maybe it's a flex building, or maybe that's an industrial building, and you rezone to multifamily, and you make some pretty nice lofts, and that way you get more value from that building, you know. So you can compress the cap rate. So that means, for example, you have an old multifamily building where it is dilapidated, and you fix this building, and you find new tenants, and or for example, for industrial, you find an industrial property that it's already leased, and you have some non-credit tenants, maybe they have bad credits, and you make some renovations, some updates, and you get better tenants, you get credit tenants there. Once you get credit tenants, I have not mentioned this, you can keep the rent. For example, if the rent was $10 per square feet, and you keep the rent, but you find a new tenant that it's a credit tenant, you also increase the value of the property. Why? Because you are reducing the risk for the next buyer of the property, for the next owner. So that way you compress the cap rate, because you are reducing the risk for the next owner of the property. Okay, so this is, for example, maybe in the junior high school, you heard about this. This is the Gauss bell. So this is the internal rate of return. What does it mean this for your portfolio? You can only get core properties, and you can only get opportunistic or value add, but you will get more variance on the results, because what this graph says, for example, you only do opportunistic. Okay, so this graph says that maybe in one deal you will be getting 20% return. Okay, but in another deal you get 0% return, or you lose money, because this one has more variance. That's what it translates to the risk. So if you don't want to get the higher the return or the strategy, the riskier the strategy. So for opportunistic, you have more variance. In one business, you may have 20% return, but in the next business, you may lose money. So you have to do a lot of business in order that strategy to balance, and you get in the 20% return. You know what I mean? So you have to support that risk, have a lot of cash, because if in one business you lose money, in the next business you will make money, but you have some cash reserves, you know. So what I recommend is to reduce that variance. You have to balance your portfolio. So this core business has no as high variance as the opportunistic, strategy, because the core business, for example, is the less internal rate of return. You have, for example, let's say 7%, but you know the next business you will have 8, maybe the next you will have 5, so the variance is less. So if you keep doing core businesses, you know you will be making around 5 to 7 or maybe 8%. But if you go with pure opportunistic, maybe you will do more, but maybe the next you will lose money. So you have to balance. You have to choose maybe 1 for this, or maybe 3 for this, maybe 1 for this, and maybe another 1 for this, depending on the risk you want to get and the internal rate of return you want to get. So let's now do some numbers. So here we have a balanced portfolio strategy. I suggest 3 core multifamily deals here. And for the deal 1, we had a 6% internal rate of return. For the deal 2, we have a 5% internal rate of return. For the deal 3, we have a 7%. And total, this core strategy, we have an average return of 6%. Okay, for the second kind of deal, we have a value-add industrial deal. We may purchase an industrial building, we may add some bays or some ramps, and we paint or do some minor updates, and we have this value-add deal. And we get 16% in the internal rate of return, with an average of 16% because we have only 1 deal. And the ground up, we made 1 ground up development, industrial maybe, and we get this 20% internal rate of return. So we invest 1 million in each deal. In each multifamily, we invest 1 million. And each industrial we invest 1 million, so total it's 5 million we invested in. So we only do the math here. We sum up 6 plus 5 plus 7 plus 16 and plus 20, and we divide it by 5, and we have the average internal rate of return here, that is 10.75%. So if we invested 5 million here, we only multiply the internal rate of return for 5 million, and we get an annualized return of almost $500,000. It's a good return for this strategy, don't you think? You can get more return if you only invest in the ground up deal, but you get more risk. Okay, so in this video I teach you how to set up a portfolio for real estate to balance your risk and to keep and preserve your wealth. If you like this video, give me a thumbs up, it helps me a lot. If you would like to watch more videos like this, subscribe. If you want to invest in real estate without headaches of operations and dealing with tenants, with trash and things like that, I have an investor exclusive club you can join. You can find the link on the description, and once I find a property like this, I will send you an email, and you can join investing from $25,000. So the link is in the description. I will send you an email once I find an opportunity for investment. Okay, see you in the next one. Thank you. Bye.